Welcome to this Killik Explains finance video. This week, how to read what's in the financial pages. Those people who are fans of the Financial Times newspaper, for example, may find it's just a wall of incomprehensible pink information. So, in a series of short videos, spread out, I'm going to take on what's in the financial pages. Where can you find useful information as an investor? Starting this week with shares. So with no more ado, just a quick reminder before we dive in, why are most people buying shares in listed companies? And it's the listed companies that tend to make their shares publicly available at the London Stock Exchange. Well, there are fundamentally three reasons. Either you want income from your shares, dividends as they're called, or maybe you're looking for capital growth, maybe you're looking for a mixture of the two, and then occasionally you get people looking for the voting rights and other perks. So the fact you can turn up and vote at an annual general meeting of shareholders makes you different to someone who owns an IOU called a bond, for example, and the other perks, discounts on the company's products and so on, do attract people sometimes. But fundamentally, I think for most people, it's dividends and or capital growth. So that begs the question, where am I going to find the relevant information amongst all those pink sheets, if you want to call them that will help me decide whether to buy a share, whether it's cheap, expensive, and so on. So, as an investor, there's lots of things you want to know about a company, but fundamentally, before you buy a share, most people in the back of their mind think, is this stock about growth in the share price, income in terms of yield, or both? So, you need to kind of think about what sort of share you're looking for. And fundamentally, once I've made that decision, am I getting what I want cheaply or expensively? And obviously the former beats the latter. So here is a hideous example of where you might try to find the information you're after. It's a snapshot of the FT, and if you think I can't read that, don't worry, I'm going to blow it up in just a moment and focus on the bits that are relevant. But towards the back of the FT, now you've got the companies section and the market section, quite clear each day. You want the market section, and about 2/3 of the way through that, you'll find information presented the same way on hundreds of companies, okay? And you get taken through each sector in the main London market, and each sector you've got lists and lists of companies. So what I've done here is just to suggest what we might do is to look at three, and you'll get these blown up in just a moment. So even if you can't read them, don't worry. So three companies, and sort of think about, well, if we were to zoom in, what is all this information here? At the top of these columns, there's lots of stuff going on. Okay, you can't even read it from where you're standing or watching this video, but what's that all about? So let's start the tour there. How is this useful in the quest for cheap stocks, income stocks, growth stocks, and so on? Okay, so let's dive in. All right, what I'm going to focus on specifically is the PE ratio. Very quick reminder about why in a moment, and something called the yield. And in this wall of information, those two are hidden somewhere. So, for those people thinking, crikey, can't see anything on there, let's strip out the noise. All right, so if you were to focus on just say three companies from three different sectors, and you were to just take the headings, if you like, that's this bit up here, that appear across the top of each of those Financial Times columns. Check it out, you'll see I've picked the same headings. What sort of information are we getting about these three different companies? Well, first of all, they are companies drawn from three different sectors. We've got house building, consumer goods, if you like, and sort of technology, for want of a better expression. So three very different sectors. So the impression we get from this key data will presumably be different according to which company we're looking at. And I'm going to do some interpretation of this in just a moment, once we've run through some revision of the basics. But essentially, what you're getting for each of these three companies is the latest share price. That was close of business the previous day at the London Stock Exchange. Now those prices will have already moved on by the time you pick up your copy of the FT the following morning, but those were the prices at the end of the day session yesterday. The change in that one session, so over the course of the day, was it positive, negative, and if so, by how much? Now for those people thinking, what are these numbers here? Well, everything's normally in pence. So that's 3,176 pence, if you like, and a change of 80p downwards over the course of the day. Then you get a comparison as to where we are now against the last 52 weeks high and low. So here, high 52-week and low 52-week is saying what's the lowest the share price has been over the last 52 weeks and what's the highest it's been over the last 52 weeks. And you start to sort of look at how does the current share price compare to that. Then two key pieces of data. Income investors want to know about dividend yields. So there it is. People looking for growth want to know about PE ratios. More about those in just a moment, and more interpretation in just a moment. And then, just to give you an idea as to how much is going on around these companies, how busy is the trading in them, because some shares are very liquid and traded a lot, some are less liquid and traded less often. You've got some volume information in thousands telling you a little bit about how much trading has gone on in the last session. So lots and lots of information. Right, before I take this any further and sum up what we might conclude from all of this about these three companies, a quick bit of revision around these two vital columns just there. Remember, PE ratios are all about growth at the end of the day. What we're comparing is the current share price, cover this in more detail in other videos, called What is a PE ratio? We're comparing the current share price to the latest earnings per share figure. So we are deriving a number that's the multiple you will pay for 1 year's earnings to buy the share now. So if the current share price is 200 pence, latest earnings per share is 20p, the PE ratio is mechanically 10. So it's a function of the current share price and a function of the latest reported earnings per share for the last year in which that number is available. You can also do it on a forward basis using expected earnings, and you can do it on a sort of average basis, but fundamentally it's based around the earnings per share. So share price in relation to earnings. Now, the yield is, on the other hand, for income investors, the annual income return on a share as a percentage. So the dividend per share, annual dividend per share, over the current share price as a percentage. So if the latest dividend per share is 10p declared by the directors, that's a year's worth. The current share price is £1, 100p. Mechanically, the dividend yield is 10%. And income investors will want that to be as high as possible, you might argue. So what's the interpretation? Just to remind you about that, cover this in more detail in other videos. High PE and low yield stocks tend to be either expensive, because you're paying a lot to get hold of them and are not offering much by way of income, or high growth. So technology stocks, for example, tend to be high PE, and people still buy them expecting future growth to accelerate. Low PE and high yield, on the other hand, either indicates a cheap share, the multiple you pay to get hold of it is fairly low. Along with a high yield, it might also indicate a fairly low static growth company. So it's one of your utility stocks, for example, that isn't really growing very fast, but generates the cash flow you need to rely on juicy dividends. Okay. So there's your basic revision. Now back to those three firms and those tables. So what am I seeing here? Let's wrap it up. What am I seeing here? So things I can do around the edges. Let's look at these numbers, yield and PE. What am I seeing? Well, I'm seeing a company that's a fast-growing tech stock. How do I know that that's a low yield and that's a high PE? How can I draw that conclusion? Well, I could put in the FTSE All-Share as a comparison, an average number. And if I did that, I would see that the yield is quite substantially below the average for the FTSE All-Share and the PE is substantially above it. So there you go, high PE, low yield. People might still buy it, expecting fast future growth. On the other hand, Reckitt Benckiser, bigger, better established, not quite as fast growing, but still above average in terms of expectations of future growth. And you've got Berkeley Homes in the house building sector, where at the moment the yield is quite generous, maybe because 5.67 plays 3.71, maybe because we're not offering market average growth according to the PE ratio. And you can do more than that. You might have a look at, say, the share price action and say, well, if we look at TeleCity, it's at 1,093 pence. That's below the 52-week high, but above the 52-week low. And if that was the 52-week high, maybe we've got a bit of a bull run going on in the stock. Or if it was the 52-week low we're seeing now, maybe the stock's having a bit of a hard time. So you can do lots of interesting interpretation around that too. And the volume data, for those people thinking, oh, if I had to get in or out of this stock in a hurry, the volume data can tell you a little bit about how much trading is going on around this particular stock. And liquidity, as I cover in other videos, is a vital part of stock market investing. So quite a bit of information you can take away from there, not forgetting the change in the latest session, how big is it, and does it suggest a bull or bear trend? It's only one day, but nonetheless it's useful. Done a lot there. I'll do some more if you'd like me to. Meantime, questions, the usual place.